Americans are falling deeper into credit card debt that they can't pay off.
And this comes as stubborn inflation forces consumers to turn to plastic to pay.
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank
facing significant challenges, both given the economic headwinds.
Imagine a world where the financial bedrock we so often take for granted starts to show cracks, not once, but repeatedly within a short span. This isn't a scene from a dystopian novel. It's a snapshot of the real financial world in 2022 and 2023. These years have been marked by significant banking instabilities, challenging the global financial landscape and shaking the confidence of investors and customers alike. Before we dive into the tumultuous saga, if you find topics like financial crisis and economic insights intriguing, please take a moment to hit the like button and subscribe to the channel. Your support helps us bring more content like this to you. In 2022, the banking sector was already grappling with the aftermath of the COVID-19 pandemic, which had left economies reeling. Central banks, including the Federal Reserve, were engaged in a delicate act of balancing inflation control with economic growth. However, despite these efforts, the year witnessed heightened volatility. For instance, the S&P 500 saw a notable dip in the first half of 2022, reflecting investor unease. But what specific events triggered these market reactions? And more importantly, how did they set the stage for the even more challenging year of 2023? As we rolled into 2023, hopes of a smoother financial terrain were quickly dashed. New challenges emerged, partially as a continuation of the previous year's issues, and partially due to the new economic developments. Key financial institutions face scrutiny over exposure to risky assets and regulatory challenges. The stock market's reaction was immediate and palpable. But here's what's most intriguing. How did these events impact you, the average consumer, and what could they mean for the future of global finance? Stay with us as we uncover the cascading effects of these financial crises and explore the measures that could prevent future collapses. In 2022, the global finance landscape underwent a dramatic shift, reminiscent in some ways of previous financial crises, yet unique in its own right. The year was marked by a series of shocks to the banking sector, each reverberating through the markets and impacting the global economy. Unlike the 2008 financial crisis, which was largely driven by subprime mortgage lending and a housing bubble, the 2022 crash was rooted in a different set of challenges. The Federal Reserve's response to the soaring inflation, peaking at around 8%, the highest since the 1980s, led to a series of aggressive interest rate hikes. These hikes, while necessary to temper inflation, had a cascading effect on the banking sector. Banks were suddenly thrust into an environment of higher borrowing costs, affecting their investment strategies and the credit terms they could offer to customers. This shift in monetary policy, coupled with the lingering economic effects of the COVID-19 pandemic, set the 2022 crisis apart from earlier financial upheavals. It was a unique blend of post-pandemic economic strain and the challenges of transitioning to a higher interest rate environment that defined the crisis. As the year unfolded, the stock market, often a barometer of economic confidence, showed clear signs of distress. The S&P 500, a benchmark index for U.S. equities, experienced significant volatility, falling over 10% from its peak and erasing trillions in market value. This decline was not just a numerical figure. It was a reflection of growing investor anxiety, partially fueled by the banking sector's struggles. Major financial institutions such as J.P. Morgan Chase & Co. reported noticeable declines in profits. For example, J.P. Morgan Chase & Co. reported a 28% decrease in net income for the second quarter of 2022 compared to the same period in 2021, illustrating the direct impact of the changing economic landscape on banking profitability. The ripple effects were felt widely. Consumer confidence tumbled, and the housing market, once a beacon of steady growth, began to waver as mortgage rates climbed, hitting an average of 5% by mid-year. more than double the average rate from the previous year. The impact on the average American was tangible. Securing loans became more challenging, saving money more demanding, and investing in the markets riskier. As 2022 drew to a close, it left in its wake a trail of questions and concerns. Was this a temporary setback, or the precursor to a more significant financial crisis? As we delve into the events of 2023, these questions become even more pressing. In 2023, the banking landscape faced an unprecedented challenge with the collapse of high-profile regional banks, notably Silicon Valley Bank, or SVB, and First Republic Bank. These institutions, once pillars in their respective niches, found themselves in the eye of a financial storm, heavily exposed to commercial real estate and burdened with increasing credit card debt. These banks faced downgrades from rating agencies. The underlying issue? A critical lapse in risk management. The banking sector, already treading on thin ice, saw lending standards tighten as regulators stepped in, contemplating expanding restrictions for these at-risk institutions. The question on everyone's mind was, how could this happen? In March of 2023, the Subcommittee on Securities, Insurance, and Investment of the Committee on Banking, Housing, and Urban Affairs convened to dissect this very issue. The hearing revealed a startling sequence of events leading to these collapses, highlighting severe deficiencies in risk management. The downfall of SVB and others was not just about poor investments or market downturns. It was about a fundamental failure to oversee and manage risk effectively. This failure wasn't contained. It rippled across the financial sector, leading to heightened scrutiny and uncertainty about the stability of the banking system. The repercussions of these bank failures were profound. The commercial real estate market, already reeling from the post-pandemic shifts, faced additional stress, complicating investments and loans tied to these properties. Furthermore, the credit card debt landscape was altered as these events led to a reevaluation of lending practices. The Federal Reserve had to step in, providing liquidity to stabilize these institutions. However, the damage was done, and the confidence in smaller banks was shaken, leading to a noticeable shift of deposits from smaller to larger banks. In the midst of this turmoil, an interactive concept began to gain traction: the Central Bank Digital Currency, or CBDC. With 87 countries representing over 90% of global GDP exploring CBDCs, the future of banking seemed to pivot towards digitization. The potential of CBDCs lay in their ability to streamline financial transactions, eliminating inefficiencies, and consolidating operations onto a single ledger. This innovation promised instant clearing of payments and universal acceptance, regardless of the payment method. The implementation of CBDCs, however, posed a significant challenge: a complete overhaul of the traditional banking system. This transformation could render traditional banks, other than the central bank, obsolete, fundamentally altering the banking landscape. For such a drastic change to be justified, CBDCs needed to offer substantial advantages in terms of accessibility, efficiency, and security. This potential to digitize currency, thus eliminating delays and inefficiencies of transactions involving multiple banks, was a key consideration. As we explore the brave new world of central bank digital currencies, it's imperative to discuss not just their potential, but also the concerns they raise, particularly regarding social control and personal freedoms. The very nature of CBDCs, digital, centralized, and government-issued, brings forth a critical debate. Could these digital currencies become tools for excessive government oversight and control? Unlike decentralized cryptocurrencies like Bitcoin, CBDCs are controlled by central banks, which are extensions of governments. This centralized control offers governments unprecedented access to financial transactions, potentially leading to concerns about privacy and personal freedom. The transition to CBDCs could mean that every transaction you make is traceable and visible to the central bank. This level of financial surveillance raises significant privacy concerns. Imagine a scenario where the government could potentially track all your purchases, from your morning coffee to your online subscriptions. More alarmingly, the potential for government overreach doesn't stop at surveillance. There is a risk that governments could use CBDCs to enforce financial censorship, limiting or blocking transactions based on political, social, or moral grounds. This kind of control could be a step towards a more authoritarian approach to governance, where financial freedom is curtailed. As we wrap up our exploration of the tumultuous banking events of 2022 and 2023, from the collapse of major regional banks like SVB and First Republic Bank to the emerging challenges and opportunities presented by central bank digital currencies, it's clear that we're witnessing a pivotal moment in financial history. These events have not only reshaped the banking landscape, but also highlighted the delicate balance between innovation, regulation, and individual freedoms. The lessons learned and the paths forward will undoubtedly shape the future of finance, impacting everything from how we save and spend to how we perceive and interact with money itself. This journey through the complex world of banking crises, risk management failures, and digital currency revolution has revealed the ever-evolving nature of the financial world and its profound impact on our daily lives.